welcome everyone. It's a great pleasure for me to welcome you all to this year's Bundesbank lecture. And before I introduce today's speaker, Thorsten Beck, I would like to first thank the Bundesbank for making this event possible. We are particularly pleased that Dr. Hubert Temmeyer, the President of the Bundesbank's Regional Office of Saxony and Thüringen, is with us today. We also welcome Tilo Liebig, who is a director at the Bundesbank and professor at TU Dresden, and who presented the Bundesbank's financial stability report at TU Dresden today. Thank you for making this event possible with your funding. I would also like to welcome the members of the faculty, the students of our faculty, and some of the alumni of our faculty. And as far as I know, some of them haven't been here at TU Dresden for the last 20 years. What I mean is not the students, but the alumni, obviously. It's a great pleasure for us to have you all with us. Now is the time of the year that Christmas is just around the corner. And what do Christmas and banking crisis have in common? They come regularly and they inspire economists. A scholar who has dealt intensively with questions of bank risk-taking and of all the regulation of banks is Thorsten Beck, our speaker of today. Thorsten was born in Hamburg and studied economics in Tübingen. Thereafter, he received his PhD from the University of Virginia. After getting his PhD in 1999, he became a young professional at the World Bank and spent the next 9 years doing research and working on policy questions. In 2008, he decided to try something new and left for a position at the economics department at Tilburg University in the Netherlands. Like many economists, Thorsten also got a taste of business administration. In 2013, he left the Netherlands for the UK and took up a position at Bayes Business School, formerly known as Carr's Business School. During that time, he also became an editor, among others, of the Review of Finance, Economic Policy, and the Journal of Banking and Finance. He also got involved with European institutions, among others, as an ECB research consultant and a member of the Advisory Scientific Committee of the European Systemic Risk. In 2021, Thorsten became the director of the Florence School of Banking and Finance and professor of financial stability at the European University Institute. Most recently, he was also appointed co-chair of the Advisory Scientific Committee of the European Systemic Risk Board, and today he will present a progress report on cross-border supervisory cooperation. We are excited to have you here at TU Dresden, Thorsten, and without further ado...
That should work now? Good, yes. Sorry for that. First of all, thank you very much for the invitation. Very happy to be here. So what I would like to talk about, and I think that maybe also fits the kind of the theme of the conference, being the theme of the lecture being a Bundesbank lecture, to discuss a topic which is both interesting for academics, but also and especially for policymakers. So I'm going to discuss basically what is kind of a research program actually that I've developed with my former Tilburg colleague, who's now in Rotterdam, Wolf Wagner, and more recently also Consuelo Silva Buston joined us in this undertaking. It's a series of papers on cooperation between supervisors across borders. To kind of take away one important point is this cooperation can take many different forms. The easiest form is a memorandum of understanding, which is a piece of paper, and we'll come back to this later, which is signed between two supervisory agencies and basically implies that they want to exchange information. Of course, the kind of the jewel diamond of cross-border cooperation between supervisors is a single supervisor, such as we have now at the ECB, the single supervisory mechanisms, but there are many different forms in between. And maybe as a way of motivation, so I remember in 2005-06, and for those as old as me, we still remember the first decade of the century, when things looked really nice, bright in general, the great moderation, rapid financial expansion, also rapid expansion of cross-border banking within Europe, with Italian banks buying German banks, for example. There was this big takeover of ABN AMRO, I'm going to come back to this, by Royal Bank of Scotland and the Spanish bank. So there was a lot of kind of movement in the financial sector. And I remember in 2005-06, I met a German economist, whom I'm not going to name, who's also worked in policy field. And so we kind of did a little bit of a tour of the horizon, kind of what are the big issues in finance back then, almost 20 years ago. And one thing we noticed is that increasing tendency to have large cross-border banks, so banks like Citibank, like HSBC, increasingly also European banks, that are active in several countries, but at the same time you have strictly national regulatory supervisory authorities. And that this is clearly a mismatch. I'm going to come back to this in a moment. And this was basically an accident waiting to happen. A couple of years later, we did have the accident. Of course, there are many dimensions to the global financial crisis, including the fact that we in Europe didn't have resolution frameworks. But one important component of it was the failure of several cross-border banks, or banks with cross-border exposures. And to the one that I was kind of physically speaking, geographically speaking, was closest to was Fortis, the Belgian conglomerate, who had bought ABN AMRO. Then ultimately Fortis came under huge pressure during the global financial crisis, first liquidity, then it turned out it was a solvency crisis. And ultimately there was no way to address the failure of this bank on a cross-border level. Even though it was cooperation, there was an MOU in place between the Belgian and the Dutch supervisors. Given that the bank was failing, it was decided, as soon as the ministers of finance entered the room, to split it along national lines and then resolve these banks separately in Belgium, Netherlands, and there was also a small piece in Luxembourg. Of course, when I say resolve, it doesn't mean resolution as we understand it now. It was more what we call bailout, effectively. So there wasn't really a proper resolution. The Icelandic Bank, another nice example, they grew rapidly in the run-up to the global financial crisis. Ultimately, in the last years before the crisis started, drawing a lot on deposits in the rest of Europe, invested a lot in the US market, failed, and of course, you know now, the depositors in outside Iceland were left drying high and had to be compensated by their respective governments. But again, another failure where there was no coordination, no proper coordination between different countries where a cross-border bank was active, because there was no proper cooperation in place. So the first thing I want to briefly talk about is that why does it matter? What is actually, so we kind of think there is something wrong with cross-border banks, especially when they get into trouble. But so in this first paper, Wolf Wagner and then one of our PhD students kind of sat down and said, well, let's first look at it theoretically and then test this. That actually if you have a mismatch between the footprint, the geographic footprint of a cross-border bank and the national regulatory parameter, so this geographic focus of a regulator, then this is, there is a mismatch that leads to a bias. And also, similar as to what the British like to say, the proof of the pudding is in the eating, the proof of regulation, supervision, of financial safety net is in the failure phase. When things go wrong. I mean, we saw it with SVB just recently, we saw it with Credit Suisse. The crunch point for supervisors, or for now for resolution authority, is when things go wrong. So actually all of my discussion will be primarily about resolution of banks, or failure management of banks, to be more precise. So I'm going to go very briefly through what I call a play model. It's very simple. Just to make a point. Imagine a bank that invests in a project in the first period. It has deposits, equity, it has assets. It invests in something in the first period. And then in the middle period, everybody finds out the likelihood of success. So with probability lambda, the project will be successful, which means it gives a positive return. With probability 1 minus lambda, the project is not successful, so a return of 0. And given this success probability, the regulator can decide to intervene the bank and close it down. In this case, so early intervention, it can recover everything. It can basically pay back depositors and at least the nominal value to the shareholders. If it allows the bank to continue, then again, in the second period, there is, the third period, sorry, there is the probability is being materialized, so it's a success. Everybody gets their money, is happy. or the bank fails, and not only everybody loses their money, but also there's an additional cost imposed on the economy. We're going to come back to this in a moment. What is this additional cost? So this is kind of the cost of a failure of a bank. I call it the domino, the hostage, and the fridge problem. The domino problem is that, as we know from SVB, we've just seen it, one bank rarely fails by itself. There are similar banks coming into trouble, partly because of similarity, because of network effect and interconnectedness. The hostage problem, the hostages are the depositors who would like to run, and we know they increasingly run with a high speed. What I call a fridge problem is a bit like, not in this climate, but remember the last summer, you take milk out of a fridge and leave it out in the hot weather, it becomes useless very quickly. So one function of banks is information creation. Information creation and also in the sense of creating lending relationships, something actually in Germany is of course very important, as we know, given the structure of our banking system. And if a bank closes down, then this is being lost. The relationship between loan officer, branch manager, entrepreneur, borrower more generally is being lost. Soft information is being lost if it's not being, if the bank closes down. And for all of this, there's a long literature basically dominating this effect. So these are the costs of bank failure. Now, if we have a domestic bank, then, I mean, there are lots of, these are by the way also some of the reasons why we regulate and supervise banks so rigorously, right? Because of the, what I call the external costs of bank failure for the rest of the economy. If there is a purely domestic bank, then we can calculate this kind of intervention point, gamma star, above this success probability, the regulator will allow the bank to continue. Below it, she will intervene and liquidate the bank in the middle period, where everything can be recovered. And then you can kind of say, yes, the higher the return in the last period, then the higher also the lambda star, or actually it's lower. And if there's a higher cost, also the earlier the bank is being intervened. So it's again, it depends on this parameter at what point the bank will be intervened. But that's not really interesting case I want to talk about, because this is kind of what we know already about bank supervision, bank regulation. But what happens if the bank invests in foreign assets? So for example, it has a subsidiary in another country and it offers lending in this country. What if it's partly funded by foreign deposits? What if some of the shareholders are foreign? Then, and at the same time, an important assumption is that the regulator, the domestic regulator, only takes into account the interests of local, of domestic stakeholders. Which again, it's I'm not saying this because regulators are nationalist people, no, because the mandate of a regulator is national financial stability. They don't necessarily take into account spillover effects of stability decisions, intervention decisions in their own country on other countries. And again, Iceland is the best example maybe for that. So what we show then is that the higher the share of foreign deposits, the higher the share of foreign assets, the more lenient the supervisor will be. So the more reluctant the supervisor will be to intervene. Why? Because the cost of the failure of a bank falls outside the regulatory parameter. The benefit, domestic shareholders, will stay in the country. Opposite, the other way is of course opposite. The higher the share of foreign equity, the quicker the supervisor will intervene. Why again? The benefits of allowing the banks to continue until the final period, so kind of betting the bank, that benefit would fall outside the country, whereas the cost, deposits, borrowing relationships would fall inside the country. So this is kind of a very simple model. Again, this is a theoretical prediction. What we then next did is said, okay, well, let's take it to the data. And of course, the kind of the best example, or kind of the best situation to apply this theory and test it, is the global financial crisis in 2008-9. Why? Because a lot of banks failed, and a lot of different banks failed, and a lot of banks in different countries failed. On both sides of the Atlantic, we had banks that are purely national, and the banks that are have a lot of share of cross-border activities. These are more deposits assets, some of them also more on the equity side. And so what we did here is basically say, we look at the point when the bank failed, and fail in this case mean there was an intervention by the government, which in most cases was a bailout, or some kind of decision. And look at 3 days earlier and look at what is called the credit default swap, which is an insurance policy that you can buy in case a firm or a bank fails. And CDS spread is basically, and you can kind of interpret it as the opposite of the lambda, in the sense how likely is that the bank fails. The more you have to pay for this insurance policy, the more likely people think, the market thinks that this bank is about to fail, or will fail during the time of the insurance policy. And so this, I'm not going to bother you with lots of regression analysis, I'm going to do this later. So this is basically, this graph kind of summarizes our results. So again, what we have on the vertical axis is the, the CDS spread at the time of failure, or 3 days before 2008-9, which, the average is around 500, which is 5 basis points, so it's 5%. The top, I think, is the Icelandic banks again were above 10% when they were intervened. And as you can see, the CDS spread was higher for banks. Sorry. Yes. The CDS spread was higher for banks that had a higher share of foreign deposits. It was lower for banks that had a higher ownership of foreign equity holders. So, and again, the extreme case being the Icelandic banks, and just to tell you the story, and again, I'm not claiming that the incentives for the supervisor were the only reasons. There are lots of reasons why the Icelandic banks went wrong. But if you are an Icelandic regulator, which is funded from outside the country, which invests a lot outside the country, but the shareholders are in the country, then from your stability viewpoint, you think you care primarily about your equity holders. And exactly that's what we've seen in the case of Iceland, which were intervened at an extremely high point of failure. So basically, they were, I mentioned, the CDS spread was, I think, 12 or 13%. Now, of course, it's an extreme example, but all the results will we take up the Icelandic banks. So this was kind of the first result. So it's also said, by the way, that this bias can go either way. It can be either that the regulator is too lenient because the cost of failure would fall outside the country, or actually the regulator might be too trigger happy, because again, the benefits of allowing them to continue are primarily outside the country. It can go either way. So, now this is the ownership base. Again, think about a bank that has, we have now lots of them, of course, in Europe, which is a parent in one bank, and then in one country, and then has subsidiaries or now also branches in other countries across Europe. Now there are also other effects, other linkages between countries which can cause such spillover effects. And that's, for example, US, Europe, if you can think of this. There are not as many ownership links, although of course we have European banks in New York, but the market connections. So if a bank in the US, for example, has to do fire sales because it urgently needs liquidity, this of course will affect global assets markets. And reduce the price of this asset in the global asset market, which in turn can also not only affect the balance sheets of banks in the US, but of course also in Europe. Now, would the Federal Reserve take into account the effects that these fire sales have on balance sheets of banks in Europe? I would doubt so. I don't think so. Again, this is another kind of externality that you can think of. There's also, of course, the regulatory arbitrage argument, in the sense that banks might establish their headquarters in a country with less stringent regulation. So we actually, I mentioned earlier ABN, before RBS, Fortis, and this, I think it was Santander, took over ABN, Barclays also threw in their hat, and they actually offered that they're going to transfer their headquarters from London to Amsterdam in case they would get, win the bet, which ultimately didn't. But there is regulatory arbitrage arguments, and of course this also means again, if all of the banks go to a country with less rigorous regulation, then of course their failure can again have a spillover effect on other countries. Now, and then finally, of course, we have the case in the euro area, where until we got to the single supervisory mechanism and the kind of the half-baked, half-built banking union, as we call it now. There were also externalities within the monetary union, because on the one hand, banks were subject to national supervision, but the lender of last resort, although formally speaking it still is, I think, on a national level, effectively it's on the ECB level. So you can not intervene, it's kind of beneficial to not intervene a bank on a national level, because you can draw on common resources, the lender of last resort, from the euro area. Not to speak, of course, of the whole issue of bank sovereign fragility, the boom loop, and all of these other things. But so this creates, common currency creates another kind of externality where bank failure in one country can have negative effects on other countries. So all of this is basically saying there is a bias if you have a mismatch between the geographic parameter of banks and the geographic parameter of regulators. And ultimately, this argument led, of course, in Europe and led to the banking union. So then the next question is, and again I'm taking a little bit of a historic view, is well, what is the response? And I still remember that in 2009-10, some people said, well, if there are externalities from these cross-border banks, why not internalize them by having a global supervisor? So this was the time when some people said, well, we have the IMF, right? That the IMF supervises the globally systemically important banks. Now, I don't think my friends at the IMF would like that, but so they never got it anyway. But the question that we ask, often I ask in this next paper, which is a pure theory paper, is this actually the answer? Should we really go to a global supervisor? Which again, from this argument I just gave you, it should be, right? Any country that's part of a global capital markets, global financial system, it has externalities, so then you should just internalize them. I mean, that's what we learn in public economics, I think we teach this. Microeconomics, externalities, you can internalize them. And in this case, it would be with a common supervisor. Well, I can tell you right away, the answer is no. We should not necessarily move to a global supervisor. Why? Because of what we call heterogeneity. Remember this little C that I mentioned in the earlier paper, the C of the bank failure? This actually might vary across countries. And if you have a common regulator that takes a decision according to the same lambda star for all the countries, that would not be welfare improving. That would be definitely not. You can show that this actually would imply that there would be suboptimal for some countries, and for some countries it would be actually better to stay national. So why is the C varied? Because of what we call heterogeneity. Countries differ. Countries differ in the legal system, let me first start with the C directly. Countries might differ in terms of how important banks are. We are, of course, here in the country, in Germany, where banks are very important, although we have a very diverse financial systems. Other countries, I mean, again, think the Netherlands, think France, for example, have a very concentrated banking system. So if one bank fails, that's a big deal. If Netherlands has 4 large banks, if one of them fails, that is a big cost for the economy. If you go to the US, I mean, yes, SVB was a big failure because of the knock-on effect, but ultimately it doesn't result in a recession because it's a very large financial system and no bank has like more than, I think, 10% is actually the highest market share. Also because a country like the US, for example, has a very large capital market, so they are alternative funding for. So again, there's differences in terms of dependence on banks, in terms of banking structure. There are also differences in terms of preferences. I mean, we are, of course, in a country which is a relatively risk-averse country, I would claim. Some people criticize this, some people like it. The US is the opposite. I mean, the US, over its 200 years, had 13 banking crises, and they don't seem to care. They just get up again, and then run into the next banking crisis. So again, all of these things, and again, I can come up with many other arguments, and maybe also the institutional arguments, is why, and this is what we de facto see, countries cannot agree on a common supervisor. And then again, if you think about the euro area, that is, of course, it took a long time till we actually got there because of these differences. But also again, for pure welfare arguments, it might not be optimal to really go to a single supervisor. So this is what we kind of summarize in this little graph here. And again, I'm going to explain it very quickly. You have the externalities. So the higher the externalities, the higher the connectedness between two countries, That's on the horizontal axis. On the vertical axis, you have what I call the heterogeneity. How different are two countries? In this theoretical model, it's captured by the C, by the cost of the bank failure. And then you can make the case that the higher the externality, and the lower the heterogeneity, the more likely you end up when, yes, in this area, the more you should actually cooperate or go to a single supervisor. The higher the heterogeneity and the lower the externality, the more likely you should actually stay with a national supervisor. So again, just to make the argument, and again, there's much more in this paper, we also talk about a colonial economy, that actually makes it likely that countries move to a supranational supervisor. But it's just to make a very simple argument again, that it's, even though you might think from the experience of the global financial crisis that yes, we should just move to a global supervisor, actually it's not necessarily welfare improving. So it's not necessarily the case that countries should move to a single supervisory mechanism as we have done in Europe. So now can we actually take this and look at what do countries actually do? And this is kind of a real preference approach. Do countries actually follow this little model? So are they more likely to move to a single supervisor if they have high externalities and low heterogeneity, or stay national if they have high heterogeneity and low externality? So this is what we then where our colleague Consuelo Silva-Buston came in because we had to collect a lot of data, which is very imperfect. I want to tell you right away. So what we did is we collected data on cooperation agreements. And again, so I'm now going again from the simple question of single supervisor to more generally cross-border cooperation. Again, what can, let me go to the next one here. What is cross-border cooperation between supervisors? So let me talk very briefly about it. So in the simplest form, it's an MOU. It's 2-3 pages typically, I think, which basically says that, let's say the Bundesbank and the Bank of Italia, 20 years ago, inform each other of material changes in the structure, ownership structure, or in the balance sheet structure of a bank that has presence in both countries. Okay? Now an MOU, as you might know, is not a treaty, meaning that it's an intention. I mean, I kind of jokingly for many years said that as the share price of a bank collapses, the value of the MOU also collapses, because again, it's you don't have to comply with it. It's an intention to comply. You cannot enforce it in any court because it's not legally binding. And it's also, by the way, it implies exchange of what we call hard information, right? Balance sheet, board structure, CEO, management changes, and so on. But there's not really any kind of soft information in there if you doubt the risk management structure of the bank, for example. So then this is the next kind of step would be what we call a college of supervisor, which typically is being called by the parent bank supervisor. It includes the supervisor of the most important subsidiaries across different countries. Now, this typically meets once a year, twice a year, to exchange information. And of course now, meeting the people that you might have to deal with in the case of crisis is of course, as you know also from the pandemic, all of us, it's of course something different. So you know that you meet the other person, kind of get to know him or her, and so that might actually make the interaction already a little bit better. That's why we see this as a stronger form of cooperation. Also allows the exchange of soft information. All of these first two, I call it kind of good weather, nice weather cooperation, because again, there are no decisions being taken, not even in the college. And it's kind of meetings during normal times, but there's no agreement necessarily in place for what to do if there's such a bank comes into a crisis situation. This would be then the next step, which would be moving beyond supervision to the resolution phase, have an MOU on crisis management, maybe have a resolution college, which then also start to exist now, where the resolution authorities are also on the table, and kind of get prepared for the possible case of a failure. And then the final, of course, the highest form of cooperation is if you basically give up national sovereignty on your bank supervision and move to a supranational supervisor. Which again, the SSM is the best example that we know. It does actually exist also in other parts of the world, in Central and West Africa. and I think the Central Eastern Caribbean. Of course, there's a big difference between the third and the fourth. It's a huge jump. So this is basically what we call the different forms of, and again, this is, I know people who work on this on a daily basis, and the lawyers, they would immediately shoot this down because they said there are lots of little details, nuances missing, it's far too broad brush, but that's typically what legal scholars tell us, economists, and we try to quantify everything, and it's never actually like this in reality, but it's a way, it's an approximation. So we collected these data, and this is ultimately what the picture that we got. So again, if you look at the bilateral basis between two countries, it of course can also be regional agreements like the SSM. And the darker the color in this picture, the more countries a specific country cooperates with. Now this is very general map, in a sense it's any of these cooperation agreements, but it doesn't necessarily mean that the intensity of the cooperation. So in Europe, of course, we now have this single supervisory mechanism, which is much deeper than having just the MOU. Right, so this is kind of the data we collected, was quite actually intensive. Let me just again, MOU, I mentioned this already, non-binding, exchange of information. There might also be face-to-face exchange, not necessarily. The college, again, it's a more permanent structure, but also it doesn't really have any decision powers, right? In the crisis situation, everybody works by themselves, because again, the college is not a decision authority. And then again, as we saw it during the global financial crisis, I mentioned earlier, this was the wake-up call. And then I keep forgetting actually who originally said it, and I wrote it down somewhere. Banks are global in life and national in death. So if it comes to the failure, ultimately the decisions are being taken at the national level, and they're not being taken in the college setting. And we also know that as the bank gets worse, and as we get closer to the intervention decision, that's where the interest of the host country and the home country diverge quite a lot, independent of where the problem actually is, because everybody tries then really to save the best parts as the interest of their own country and the financial stability of their own country in mind. So, what does it imply? So we went then to, it was also partly driven by the international institution, the FSB for example, the BIS, to arrangement where supervisors would actually kind of prepare for such worst-case scenarios where a large cross-border bank fails. In terms of simulation exercises, crisis management plans, crisis management groups, as it now exists for the GSIPs, but also, for example, including other authorities, resolution authorities, deposit insurance, and, of course, maybe also the Minister of Finance, because it's ultimately the Minister of Finance who represents the taxpayer and might have to put money on the table. Again, I'm going to come back to this in a moment. The Scandinavians actually were the ones that were farthest ahead with this. But of course, ultimately in the euro area, we went to this kind of to the step with the single rule book, which is more the supervisory side, but then also the broader cooperation driven by first the SEPs and then the EBA, and ultimately definitely on the supervision side, partly on the resolution side, having one single authority in place. So you can see that the 2008-9 crisis was really also a quantum jump in terms of cross-border supervisory cooperation. And again, Europe is of course the region where it kind of moved forward the quickest because of the euro, I would argue, and because of the crisis, but in other parts of the world we've seen a similar kind of acceleration, intensification of cooperation among supervisors in cross borders. And the one region where I've done a lot of work is Africa, for example. In Africa you've seen a similar push towards more cooperation between supervisors, of course, on a much lower level, starting from a much lower point. So again, let me go back to my little graph here. So can we actually test the hypothesis that countries that are more exposed to each other are more likely to kind of cooperate with each other, and countries that are more heterogeneous from each other are less likely to cooperate? So that's exactly what we did in this first analysis. So now I do show you a regression result, and I'm not going to go through the details, but yes, it is. So externality being measured by the share of cross-border banks in each other country, by correlation between stock markets, by having a common global systemically important bank, by having a common currency. These countries are more likely to go into a cooperation agreement. Countries that are more heterogeneous from each other, so for example, different languages, geographic distance, developing versus developed countries, different legal origins. All of these countries are less likely, all of these elements drive countries to be less likely to cooperate with each other. So there is some economic arguments, it's not just about politics, there is something, an argument that economics does play a role in terms of countries deciding, the supervisory authorities in a country deciding whether or not to cooperate with each other. There's also, it's a big effect, and it's also, this is only a pure cross-sectional, we look at 1 year. I think back then we had only data until 2013. But also when you look over time, this holds true. Countries are more quicker to go into a cooperation if they have higher externalities or lower heterogeneity, and also they go into more intensive forms of cooperation. But maybe beyond any regression analysis, I always like to quote the example of Scandinavia. Because they were kind of a little bit ahead of the rest of Europe. They actually created the first, this doesn't work quite well. They created the first supervisory college for Nordea. Nordea, a large Scandinavian bank that was created through mergers in 2001. Externalities. And that's when they started the college. They actually already went to a MOU on the management of a financial crisis in 2003. So 5 years before the global financial crisis. After the crisis, they had a Nordic-Baltic Stability Group, Nordic-Baltic Macroprudential Forum, Crisis Management Group for Nordea. So they actually, as you can see, they actually went relatively quickly in this kind of cooperation. And again, why? On the one hand, there are a couple of large cross-border banks that dominate the Scandinavian financial system. Nordea, Danske Bank, Handelsbanken, there's one or two more. And not only, they don't mostly work through subsidiaries, they actually work through branches. So they're really, it's a very closely integrated financial system, which again makes the externalities of a failure in one country of one bank relevant for all other countries. So high externalities, extremely low heterogeneity. I mean, if you think about Scandinavia, I mean, except for Finnish, the languages are very similar. The history, I mean, these countries used to belong to each other in different forms over time. Political structure, very similar. So it's not surprising that these countries actually managed to work together quite well, and they started cooperating with each other much earlier than in the rest of Europe. So this is kind of my kind of anecdotal explanation, or my case study, so to say, behind the regression analysis that I showed you in this case. By the way, another example, if you want, is the so-called Trans-Tasman cooperation between Australia and New Zealand. Australia and New Zealand are two countries which are financially very closely linked. Why? Because the largest 4 Kiwi banks are the largest 4 banks from Australia. So the 4 largest Australian banks have subsidiary in New Zealand, which then again are the largest 4 banks in that country. So there's a close interconnectedness, and obviously both the Australian Prudential Authority and the Reserve Bank of New Zealand, they're both interested in the stability, what's going on in the other country. So these countries actually started also cooperating very closely. And here comes the special part. I told you earlier that regulators, by their law, care about national financial stability. Well, in the case of Australia and New Zealand, actually in the respective Banking Act, it says that the regulator has to take into account the stability interests of the other country, which is kind of weird. I mean, it's not something we would expect. Of course, it's a very generic formulation. I mean, what is the financial stability interest of the other country? But at least there is a legal mandate, actually, for the authorities in the two countries to take into account what's happening in the other country. And therefore, also, this is obviously implies a much closer cooperation between Australia and New Zealand than among other countries in the world. So, now, so if you kind of want to put this together in a little bit graph, so I kind of, and this is now more like a policy slide, if I may say so, rather than a research slide. Why? Because in my regression analysis, my theory part, it's kind of, I talk very loosely about these things, corporation, single supervisor, and so on. But of course, there are the 50 shades of gray between the white and the black, right? So again, you have very broad cooperation. I mean, you can think about the Basel Committee, about FSB working groups, where just we agree on joint standards. Then if you go up to, does it still work? Oh, sorry. Oh, sorry. We go up to supervisory calls and MOUs, as I said, these kind of good weather cooperation. Then over here, closer cooperation, GSIPs, regulatory convergence. You can think about US, Europe, stronger ex-ante agreements, resolution. I told you about the cooperation in Nordic Baltic, legal commitments like between Australia and New Zealand, and then ultimately the strongest form, which would be like the single supervisory mechanism. So there's a lot of different variation. And of course, ultimately the question is, where you have high externality, that's where we kind of want to move to. So now so far, I've talked about assuming that having these cooperation agreements is actually something good. Actually, they are effective. Are they actually effective? That's the question, right? So this is kind of another, well, it's part of the same paper, but it's a part of the third paper, where we said, well, let's actually measure the impact. Now, how do you measure the impact of supervision on bank stability? Likelihood of failure. We would have loved to do this, but it's very difficult to do because first, there are not that many failures of banks, and typically failures of a bank don't come by themselves, right? They come probably in chunks. I mean, as you've seen it even like in March back in the US. And then, of course, the question is, how do you define a failure? Because Credit Suisse didn't fail, right? We know it was sold to UBS. It didn't really fail. So what we do here is we look at two kind of stability indices, variables on the bank side. One is more a balance sheet based, which is the Z-score. The other one is a marginal expected shortfall, which is based on market data. And basically ask the question, if you look at the 197 cross-border banks around the world at the group level, does more cooperation between the parent bank and host country supervisors, does it improve the stability, or is it, let's say, correlated with the stability as measured by the Z-score or the marginal expected shortfall? And again, we looked at this within banks. We have the bank fixed effects. We have year fixed effects to control for the global financial crisis and so on. And this cooperation variable here is, so it's basically the share of foreign assets of a banking group which is covered by an agreement between host and home country supervisor. And when we do that, again, quick regression table, yes, it is, but, sorry, for economists, there's always a but. There is an improvement in stability, but only for the smaller cross-border banks. Now, what is a smaller cross-border bank? Think about Raiffeisen, Intesa Sanpaolo. So not the GSIPs, let's put it this way. So for the largest of the cross-border banks, I'm sure the GSIPs, we don't find, there's still a positive effect, but it's not a significant effect. So the question, of course, is why? And I'm going to come to this in the final paper. Before that, it's a relatively big effect. So it seems that yes, cooperation between supervisors can have a stability enhancing effect. And again, there's lots of more tests in there, also for heterogeneity and so on. But it doesn't work for the largest, for the GSIPs. Or put it differently, the too big to fail effect cannot be really addressed with cross-border supervisory cooperation. So, now, and this brings me to the final paper of the evening, which is regulatory arbitrage. So the first thing is, of course, we know bankers are very smart people, and they always know how to get around it. We also know, and this is again a large literature, that there's risk shifting happening as a response to regulatory changes. You can even see this like in a completely different area, in green finance. If you tighten climate restrictions, lending restrictions based on climate or investment decisions in one country, then the bad stuff, the brown stuff, is being sent to some other country. So it's being booked in a different country. So the question is again, do banks react to changes in the regulatory architecture? And for this very specific case, what we look at is whether banks actually shift risk into a third country if there is cooperation or stronger cooperation between country A and country B. And actually this also explain why we don't observe these stability enhancing effects of supervisory cooperation for the largest cross-border banks, for the city banks, the HSBCs of the world, because again, they would have more opportunity to actually shift risks as long as there's no similar cooperation across all of their host countries. Again, there is a long literature on this already. We focus on one specific aspect, that is the supervisory cooperation. So now, in this previous paper, I focused on the banking group. Now I focus on the subsidiary level, because I want to observe the risk shifting from one subsidiary into the other one. Good. Giving first a first graph I want to show you. This is the effect, the average effect, if an agreement comes into place between parent bank and this subsidiary in country A, let's call it. This is the lending growth. As you can see, after the agreement comes into place, the growth path kind of goes down. There's still growth, but it's much more shallow growth. It's much lower growth than leading up to the year of the agreement. Now, obviously, this is a correlation. You can't really imply any causality, because there is, of course, a reason why this might come into place, this agreement, because of the rapid growth beforehand, and maybe the growth has, the lower growth after the agreement has nothing to do with the cooperation agreement, but with some other factor in the host country or in the home country. So that's why we said, well, let's look at this third country effect. So, to kind of illustrate that, I'm taking the example of RBS, which actually, 2008, 2009, which in between it failed, it was bailout, but that's a different story. So in 2008, which back then was still the FSA, the UK regulator, there was only one agreement in place between the FSA and the supervisor in Mexico. None with the other countries where the RBS had a subsidiary. Fast forward 1 year, the FSA in the UK had agreements with Ireland, CBI, Poland, and Romania. In the meantime, they also, RBS was forced to divest from Brazil and Venezuela. It still didn't have any agreements with Argentina or Pakistan or China. Now, what are these percentages in these boxes? It's focused, let's say, on Argentina. From the viewpoint of the Argentine subsidiary, the RBS, the parent supervisor of RBS, has agreements with 0.1 of foreign assets of RBS outside Argentina are covered by a supervisory cooperation agreement, which is the one in Mexico. Fast forward in 2009, 93% of foreign assets outside Argentina of RBS are covered by a cooperation agreement, which obviously is driven by the Irish subsidiary. So what we want to look at is the effect of increased cooperation of the UK, in this case of Ireland, Romania, Poland, on the subsidiary in Argentina. Okay? So it's a third country effect. Kind of the argument being that there's no causality, there's no reason why an agreement, why the situation in Argentina should have an influence on why FSA in UK and CBI, the Central Bank of Ireland, start cooperating with each other. So it's an exogenous shock for looking at Argentina in the sense to observe what happens if cooperation outside Argentina increases what happens to the subsidiary in Argentina. Right, so this is kind of summarizing it in a graph. This is similar to the previous graph, but now looking at the third country effect. And you can see there is, after this agreement, this agreement between, let's say, Ireland and the UK comes into place, in Argentina, and again, these are not the numbers for Argentina, these are more average numbers, the lending goes up in third countries. Okay? Parent country, host country B, host country A start cooperating, lending in host country B goes up. That's the summary. So there's a higher volume of lending in the third country. Now, is this more risk or not? I'm going to come back to this later. So, again, we run this with a formal regression. The group cooperation is similar measured to what I told you earlier, but now we always include the country of the subsidiary itself. We really look at these third country effects. And what we find is, yes, indeed, as I showed you in the graph, lending goes up in the third country if there's an increase in cooperation between parent and host country supervisor A. More lending in third countries. Controlling for all kind of other stuff. Let me just mention very briefly, this is not driven by any other country characteristics. So in the kind of what I call the tightest identification, we compare, to give you an example, Santander and BBVA. Santander and BBVA are two large Spanish banks that are active across Latin America. Now imagine a situation again before the existence of the SSM. Bank of Spain Banco de España starts cooperating, let's say, with Banco de Brasil, Banco Central de Brasil. What happens to the lending of BBVA and Santander in Bolivia next door? And again, we compare Santander and BBVA, controlling for anything else that's going on between Spain and Bolivia. How can we do this? Because the regulatory the geographic footprint of Santander and BBVA might still vary across Latin America. So that also means that this variable, group cooperation, third country group cooperation, varies for the subsidiaries of BBVA and Santander in Bolivia. So that's kind of the variation we exploit. So it cannot be driven by anything happening in Spain or in Bolivia or between Spain and Bolivia. It is really on the bank level that we capture this variation. Good. Lots of other things to say here, also including that again we have this negative coefficient here when the subsidiary country directly starts cooperating with the home parent country. In this case, of course, it's negative. It's not as well identified as I mentioned earlier. It's a large increase again. It's also, by the way, it's an increase in terms of the market share in the foreign country. And so this is again kind of a not as clear but similar graph as I showed you earlier in terms of treated groups where cross-border cooperation between parent country and third countries goes up by more than the median, or goes up by less than the median. That's a control group. As you can say, then lending, in this case Bolivia or Argentina, from my earlier case in RBS, goes down after the third country agreement comes in place, whereas it goes down for the control group, at least for the first 3 years. Of course, then afterwards, lots of other things are happening, so we can really only talk about the short-term effects within the first couple of years. So, by the way, risk, again, this is all balance sheet based so far. Total assets go up, equity growth goes down, Z-score, my indicator of stability, also goes down. So it's not just more safe lending, but it's also actually more risk-taking on the aggregate level. But now you might still wonder, can we really talk about risk here? It's only about lending volume, right? And I can't even say, is it household lending or is it enterprise lending or which sector is it lending to, because we don't typically have these data on the bank level. So we do a different exercise where we go to syndicated loans. Syndicated loans are large loans given typically by a group of banks to large firms and often given by cross-border banks. Now the other thing about syndicated loans is they don't necessarily have to be booked in the country of the borrower. You can book it somewhere else, in a different subsidiary. So that's exactly what we're exploring here. We're saying, take a sample of loans. In this case, we have what? 3,100 loans, 54 banking groups, a little bit less now. Loans that have been given to a borrower where this cross-border bank participated. What is the likelihood that this is being booked in this specific subsidiary? So again, let me go back to my graph here. Yeah. So RBS gives a loan to a borrower in the US, where RBS, at least according to this graph, didn't have a subsidiary. Maybe it did in the top example. Then RBS can choose where it wants to book this loan. And the hypothesis would be that after the increase in cross-border supervisory cooperation, the likelihood that this loan is being booked in Argentina, Kazakhstan, or China increases, because there is now closer, and it decreases for Ireland, because there's now a closer cooperation between FSA and the CDI, for example. So you kind of put certain loans in a different subsidiary that is not necessarily subject to this kind of cross-border cooperation. So, and as I guess you can guess, yes, that is actually the case. There is an increase that loans are being shifted into a different subsidiary. Now you might still say, what does it have to do with risk? So it's again a big increase, but we look at so-called risk indicators of the borrower, the Z-score. Again, higher Z-score, more stable. Lower Z-score means more riskier. The borrower size, we typically like to think, so this is just about the total assets of the borrower. We like to think about larger borrowers as safer borrowers. A core, which means that this bank has lent to this firm before, so it knows the firm, which also kind of sees it as less, as more stable. And then finally, the loan spread, which is actually it's a kind of a direct indicator, positive indicator of riskiness. The higher the spread over the LIBOR, for example, the riskier the loan. And as you can see, the effect of third country cooperation on the probability that this loan will be booked into this country, into the subsidiary, increases in the riskiness of the borrower, in the riskiness of the loan. So that, I think, gets us closest to kind of a strong effect, not just in having more lending being done in third countries, but also being more risk booked into a third country when you see cross-border supervisory cooperation increasing. So there's a couple of other things. I don't want to talk too long about this. There is, well, I mean, maybe not talk about this. This varies again, this impact of the. So now I'm going back to lending, by the way. I kind of left the loan level side. Go back to lending. It varies again with certain characteristics. Has there been actually the number of host countries, for example, that has already been subject to cooperation, which is this one here, the last one, which means, of course, there are fewer opportunities to shift risk. Again, the effect, therefore, is stronger. If there is, of course, already cooperation in place, the effect basically goes away. That's the first one. And then, if there is cooperation between the host countries, for example, Argentina and Ireland, for example, then the effect is also less strong. So there, you can paint a much more complicated picture once you take this into account. But actually, the last thing I want to talk about is what can the national supervisor actually do? What can the supervisor that I mentioned earlier in Argentina or Kazakhstan do in face of this risk shifting? Now that gets me, of course, to a different point. That I kind of described this risk shifting, or kind of implied that this risk shifting is something negative, that the third country actually doesn't like. But maybe they do. Maybe they want to attract this risk. Maybe they want to have a large financial system, and the way to get it to a large financial system is by attracting this kind of regulatory arbitrage. So I'm not excluding that. I'm more thinking about countries that kind of maybe don't want to attract this kind of attention, so to say, kind of the risk. And what they can do is, yes, they can strengthen their own supervisory framework. Capital stringency, more market discipline, so the opposite of a large deposit insurance. Invention power doesn't really come in significantly. Which brings me to another kind of example. I don't think I have a slide on that. We have come to a lot of cooperation, of course, within the European Union. We obviously have the single supervisory mechanism. But even for non-Euro countries, we have a certain role for the EBA. So if you are, let's say, let's say UniCredit is active in Czech Republic, the SSM, previously Banca Italia, now the SSM, has to invite the Czech supervisor into the College of Supervisors, and also actually ultimately the College of Resolution Authorities. So that's by EBA. If there's a conflict between authorities within the EU, then the EBA has a certain mediation power, except when it comes to money. Not surprising. Fiscal power is still very much on the national level. There is a lot of, even beyond the euro area, there is a strong role that forces countries in the EU to cooperate with each other. On the other hand, you have these so-called small host countries which are outside the EU. Think Albania, Montenegro, Serbia, where the, let's say, Unicredit and Societe Generale have a very large market share. So these banks are very important for the country. But of course, the Montenegrin part of, let's say, Unicredit is 0.2, 0.3 of the overall balance sheet of Societe Generale in Paris or Unicredit in Italy. So it's from the viewpoint of what used to be Banca d'Italia, Banque de France, now the SSM, the fate of the Montenegrin subsidiary of Unicredit or Societe Generale basically doesn't matter. So this is what I call a clear asymmetry between the parent bank supervisor and the host country supervisor. Very important for the host country supervisor, parent bank supervisor couldn't care less. So this kind of asymmetry, and within the EU, we've kind of resolved this through EBA guidelines. Outside the EU, these countries don't have any power. So the only way they can kind of defend themselves, so to say, is by strengthening their financial safety net, because that would reduce this kind of risk-shifting tendency. Of course, there's another way to go about this, and that's something also many countries in sub-Saharan Africa do, is so-called ring fencing. So making sure that if something goes wrong in the parent bank, that the local subsidiary can actually continue to function. So they force basically the IT system to sit in the local subsidiary. They want to have only locals on the board. HR has to be local. So basically make sure that if something happens, the bank can continue to function. But of course, this comes at the cost of efficiency. Because one of the reasons why we have cross-border bank, well, lots of reasons, but one reason that we typically like to think of is an efficiency argument. Okay, so again, regulatory arbitrage can happen, but there's also for countries, there's a way to basically counter these effects in case cooperation doesn't take place. So, I think I'm actually already at my conclusion. Maybe I talk too quick as always. But let me try to summarize a bit and maybe bring a little bit also the policy aspect in here. So first, I started out arguing that there is this mismatch between geographic footprint of banks, geographic regulatory perimeter, which leads to biased supervisory decisions. And I always say biased supervisory decisions, what I mean, of course, is typically the intervention decisions. Because that's the point, again, as I mentioned earlier, the proof of the pudding is in the eating. The point you can also argue, when a supervisor declares a bank is failing or likely to fail, as in the kind of supervisory language. Does it mean that we should move, given these externalities of bank failure, on this biased intervention decision, does it mean we should move to a global supervisor? No. There's a trade-off between heterogeneity on the one hand between countries and the externalities. That's why we observe that some countries barely cooperate at all. I mean, think about Ethiopia. Ethiopia doesn't allow any foreign banking, so why should they cooperate with anybody? There's no need for it anyway. Or also because there are a large difference between countries. Again, there is the cooperation between US and Europe more generally. Yes, it's there, but it's not as close as, for example, within Europe. Then also, and again, I gave you the example of Scandinavia or Australia and New Zealand, who has a very close cooperation. Why? Because, I mentioned this, actually didn't mention this for Australia and New Zealand. Of course, for them it's easy to cooperate again. Same language, used to belong to the same country, the UK, still part of the Commonwealth. So there's a lot of commonality, so it's an easy language. It's easy for them to cooperate. And at the same time, they're very high externalities. Again, the same applies to the Scandinavian countries. And again, given you might argue why did the euro area actually end up with the banking union, given there is quite a heterogeneity between countries? Well, yes, because again, it was driven by the crisis, it was driven by the very high externalities caused by the crisis and by bank failure in certain countries, coming ultimately through the common currency, and that ultimately drove us to the SSM. Cross-supervisory cooperation, can it be good? Can it be effective? Yes, though not necessarily for the largest banks. And again, in a separate literature, there's a couple of papers that actually look at specifically the effect of establishing the SSM. They have found a similar effect for the SSM. And again, if you can, the storyline, if you think about the comprehensive assessment in 2014, which showed the enormous heterogeneity in terms of asset quality and the reporting of the asset quality, more importantly. Basically, there are a couple of figures that have shown that banks that came under direct supervision of the SSM, the so-called significant institution, actually have improved their stability in the last 10 years or so, have also actually taken on more capital, also have reduced lending, that have taken less risk. So there again, this is another example that where this actually has gone. Now, having said all of this, there is, as I showed in the last paper, there is still this arbitrage. There is still, and again, as long as you don't have perfect cooperation across countries, which you don't because of the argument I made earlier that a global supervisor might not be welfare including, as long as we have this variation, there will always be regulatory arbitrage across countries. Banks trying to shift risks to other jurisdictions where there are, there's less kind of, there's either less regulation supervision, or again, there's less cooperation between the host and the home country supervisor. Again, countries can kind of defend themselves if they want to by strengthening their own financial safety. So I think that's pretty much all I have to say. So I maybe on the last point, just to say what is the policy implications on that. I mean, so I mentioned earlier the small host countries in Southeastern Europe. And actually the reason I mentioned this because I've actually participated in a policy report we wrote for the World Bank a couple of years ago, well it's also almost 10 years ago, looking at it from the viewpoint of the small host countries. Of course, then the idea would basically strengthen the role of these the small host countries vis-a-vis, for example, the European Union, vis-a-vis the SSM, when they kind of give them additional rights or allow cooperation between these supervisors, for example. That's something we also ultimately told the authorities in several sub-Saharan African countries, which now have similar position vis-a-vis the European supervisors, because the European banks have an important role within their jurisdiction, but again, the balance sheet of the subsidiaries is minuscule in the overall balance sheet of the banks back in Europe. So there are kind of policy indications that come out of this. So that's what I had to say. I kind of want to give you a little bit of insight into this field. Again, there's much more to say. There's actually much more ideas that we have, which we can explore. But I think it's also an area where the policy world actually keeps driving this process forward. And there's much more I could say about this, which I will not in this forum here. But I think it's an exciting area also going forward. Thank you.
Thank you very much, Thorsten. We have now time for a couple of questions, and we have this little cubic here. So whoever wants to ask a question, just
I can start. So thank you very much for this really fascinating talk. My question is, do you have any insights on the channels, micro channels, on why this cooperation between countries works? They don't have any power, the incentives don't change. So what's the channel? Why do banks react?
Oh, why do banks react actually to that? Okay, that's
Well,
just about
behavior of supply or demand side first.
Yeah, no, it's okay. That's a very good question. Actually, this is the part of the presentation I left out. So it's good that you asked me about it. So we actually looked into this again with complicated regression analysis, which I won't talk about. But so it is. So number one, it's not necessarily on the capital requirements. It's more on the risk taking of banks. So that's number one. Number two, banks react to this because. Well, mainly for two reasons. Because supervisors are more likely to cooperate on early intervention. So the banks are more likely to be intervened early enough if there is a cooperation. Even if it's only a soft cooperation, at least there's enough information available that allows them to start thinking about when to intervene in the bank. And the other one is that actually cooperation also seems to kind of up supervisory standards. There's also a positive effect, a kind of more convergent supervisory standard. It does not seem to work through a third channel that we tested for, which is kind of that banks become more transparent. So that's not really the case. So there might be more supervisory information, but there's not necessarily more information on the markets, for example, through balance sheets, information and so on.
Yeah, thanks for the nice talk. I would be interested if these cooperation and investment treaties are somehow aligned, because I mean, if you're like the Argentine government, you do not have any investment treaty with, let's say, Germany, and then a German bank runs into trouble, and the Argentine government can easily expropriate Deutsche Bank, Germany, and you can easily resolve the problems and can ring-fence the subsidiary in Argentina from the conglomerate. It's not easy to transfer any cash flows from Argentina to Frankfurt. Back then it would be a very clever idea for the Argentine supervisory agencies not to cooperate with Frankfurt because they have just no benefits in terms of prices, right?
Yes, so what I wanted to mention earlier, you could start ring fencing, right? Again, there is an efficiency loss that comes from the ring fencing, right? Because you get less benefit out of from there. I mean, especially for host countries and developing countries, there can be benefits from cross-border banking because it's you get skill sets, you get new products, you get new capital typically. So there are lots of benefit coming from that, of course. But on the other hand, there's a stability risk that comes in. I mean, we've seen it also especially in Central and Eastern Europe after the global financial crisis when parent banks basically kind of drew down lending, funding for these banks because they were partly funded by the parent banks. Yeah, you could do, of course, the ring fencing again. There's an efficiency loss, and of course, if you just expropriate it, that's also again, it's only so many times that you can do it, right? Because otherwise, then you will foreign banks won't come back if you keep doing it. So that's the other downside to it, I would say.
Yeah, thank you very much for your excellent presentation and providing a lot of insights to think about it. I'm very much interested in the third-party cooperation and the impact of this third-party cooperation on channeling risk to other countries. Not on Eastern European countries, smaller countries, but on big countries, big regions. What about the relationship between the UK and Euro area? We have this Brexit. Yep. After Brexit, a lot of discussion about the Euro agreement, and then we have new agreements. Does this new agreement or agreements have an impact on channeling risk to other countries?
Yeah, okay, that's a that's a very good question. So, I mean, I could actually we did actually report for the Commission on that exactly, for DG FISMA, exactly on this future cooperation between the UK and Europe, and it was actually before we finished it before the Windsor framework, and then of course the Windsor framework happened, which then also kind of unlocked the whole cooperation on financial sectors. So the one thing that I first want to say is, and I again have observed with somebody being part of the ESRB structure, is that cooperation on a technical level has never stopped. You know, I mean, you know this as much as I do, right? ESMA has cooperated with the authorities in the UK, including on the CCPs, for example. So there is cooperation, but of course the broader regulatory cooperation has kind of stopped until the Windsor framework came in place. And the question, of course, on the CCPs, that comes up every couple of years, and every couple of years we have the same kind of argument. We have the argument of the markets who say, well, no, there's a scale economy argument, that's why you should leave this in quiet and leave it in London, and everything is just going to be fine. And then there's, I think, a very relevant stability argument on our side, so to say, on the EU side, that if something happens, then how easy will it be to cooperate it between the UK and Europe? Because again, these MOUs are non-binding elements. And we also know that the UK government can be very, very ugly. We see that how they treated the Icelandic, basically using anti-terrorism law against the Icelandic supervisors in 2008. So I see both arguments. The only way I see it to come to even stronger arrangement and cooperation between the British authorities and the European authorities, in this case ESMA, I guess maybe because they are the CCPs, in terms of planning for the worst case scenario if something happens for them. I mean, if it comes to more general relationship or the kind of between the UK and Europe in the financial sector, I mean, divergence will definitely take place, not necessarily partly active divergence, the UK just saying, I mean, we see it now with the bonus restriction, which was they got rid of, or they are getting rid of, but also passive divergence, so basically the UK not keeping up with changes in European legislation, which of course there is a lot. And we know, of course, with Basel III, for example, the last piece is being, there are differences between the UK and Europe, although I think the UK is actually closer to the spirit of Basel III. So there will definitely be more divergence coming from that. Now, ultimately, I think will it mean that the UK will lose its space, its spot as a financial center also for Europe to a slow extent, but not really at a big extent. Why? Because there's no alternative. There are too many alternatives. Basically, the business is being spread out, right? You have it partly in Paris, Luxembourg, Frankfurt, a little bit in Milan, Dublin, of course, a lot. But there's not one center that can take over, or that we Europeans could actually agree on to take over the role of London. So I don't see that actually happening. So I'm not sure whether I answered your question. I think I rambled a little bit more than that. But there's no clear-cut kind of break, I would say. There's certain cooperation. There will be kind of tension points, especially also decision points on our side when it comes to the CCPs. But I think it will be like Durchwursteln, mixing, going through, struggling through, basically, yeah, muddling through.
Any more questions? If not, I will have the final question before we go for the reception. So I very much enjoyed your result on regulatory arbitrage, and that you could actually see that in this third country subsidiaries, the loans are increasing after an agreement has been struck. So I was wondering what the incentives for banks actually is on the micro level to move to these countries with their loan extensions, because it's apparently not the bias in regulation, right? Because you said bias in regulation would occur because if there's a supranational supervisor, then you might have this type of bias. So what is it actually that makes it for banks more profitable to extend their loans somewhere else?
Well, I mean, so if I understand again, I'm not spend a little bit of time in banks, but I'm not a banker. I mean, there is a general risk appetite, which normally banks would say, I have a certain risk. Banks would say, I have a certain risk appetite, and then I act on this, right? And if I have to reduce my risk in one part of the bank because of regulatory restrictions, because, for example, of cross-border supervision, then I would shift my risk somewhere else to maintain my overall risk profile. I think that would be the most direct answer I would give. And again, it's the same argument for any other type of regulatory arbitrage. I shift my risk according to regulatory restrictions. Why? Because I want to maintain the overall risk profile, which of course then should, map into certain profits and again risk for the shareholders. That would be my answer.
Okay, perfect. Thank you very much, Thorsten. I think this was very illuminating. And thank you again also to the German Bundesbank for making the event possible. And so thanks everyone for coming, and you're more than welcome to join us for the reception